The stock markets, the prices and the levels of the major indices in the stock market have returned to their pre-recession, pre-2008 levels. So in a sense, that looks like good news. At the same time, however, the valuations in those markets are still a bit stretched. When we look at the stock market and we look at the price level, we really have to compare it to the corporate earnings. And the valuations are kind of relatively high. When we compare them to history. So our prices have moved back in the stock market. The stock market has improved since the financial crisis. A lot in part to the liquidity that the Federal Reserve has given the markets, but the valuations are still in big questions. So you have a market that really is at risk of reversing itself quite quickly. The $85 billion a month that the Federal Reserve is currently buying consists half approximately of U.S. Treasury, long-term U.S. Treasury bonds, and half primarily of long-term mortgage-backed securities bonds, which are also backed by the U.S. government. The so-called quantitative easing program, these purchases, their objective is to keep longer-term interest rates lower than they would be otherwise. The hope is that it will support the housing market and other industries that rely on long-term debt. It's really not designed to help the banks. We are well past helping the banks in terms of policy. The Federal Reserve's accomplished that by increasing the liquidity of banks in just a couple of years. That really happened by 2010. So it was really 3 years ago that the banks were back on their feet, they were making profits, and they were rebuilding their capital base from all the losses they took in 2007 and 2008. So the quantitative easing, the bond buying by the banks, is really an effort to try to spur economic activities. It's supported the housing market. It's helped a few industries that rely on long-term debt, like the auto industries, but otherwise it hasn't done much for the overall economy. If that is pulled away, will it change the economic situation? Probably not that much. It'll affect those sectors of the economy, the housing, perhaps, and the auto industry. But it hasn't had an effect of actually increasing economic activity. If it had, we'd have much lower unemployment, we'd have much faster job growth, and it's just not working that way. Right. With interest rates near zero, particularly short-term interest rates near zero, they really can't go negative. And so they are at the bonds, the short-term bonds are at their highest price they can be. But that is in the short-term market. So can that bubble burst? Sure. You know, the high price of short-term bonds can reverse itself, and short-term interest rates can go up. That doesn't really concern me as far as the economy goes. The question is that when that money that was in those short-term bonds leaves that market, where else is it going to go? That's the big question. That's the big uncertainty. If that money leaves that segment of the financial markets and goes after land or commodities, we're going to see price inflation. And that's going to hurt the regular consumer. That's going to hurt the economy overall. If instead that money heads to, say, the stock market or gets invested in businesses, perhaps new businesses, new startups, that's a positive for the economy. That gets jobs going, that gets new technologies invented and research done and new investments made. That could be a real positive. So the question is the Fed policies and other policies have pushed people into cash, into holding cash. So as that turns, which it eventually will, and just don't ask me to predict exactly when, I'm not real good at that, but when it'll eventually turn, the question is, where does that cash go? And I'm hoping that it goes into new businesses, investments, and new technologies. If it just goes back to buying up lands and big houses, we're right back where we were. That would be a dangerous situation. Yeah, well, it could be worse. It could be worse because we haven't dealt with many of the financial crisis issues. We still have heavy subsidization of the housing market by the federal government. 9 out of 10 of all mortgages today that are initiated today are backed by the federal government. So we still have trillions of dollars of federal government obligations backing the housing market. That's one of the things that led us to the crisis. That hasn't changed. We have a huge financial market regulatory new law called the Dodd-Frank Act. It's pages long, it has many different legs to it, and it has yet to be implemented. So we have no idea what all those rules are going to end up looking like, or how they're going to affect, or what consequences they're going to have with lending, or so forth. So there's just a tremendous amount of uncertainty. So we haven't dealt with the financial crisis. We haven't changed anything. The Consumer Financial Protection Bureau is this huge new bureaucracy that we have no idea how it's going to affect the financial markets. So it's very scary, very uncertain because of that. What we have seen already, the little inklings, if you would, as to how banks are going to react to these laws, is most evident in the student loan market. We just heard announcements just a couple weeks ago from Bank of America, JP Morgan Chase, that they're completely leaving the student loan market. Why? Because the federal government, the Department of Education, it jumped in and said that any new student loans got to be initiated by us, and they jumped into that market. So if that is any indication, the Consumer Financial Protection Bureau is going to drive banks out of different markets, and that will have a direct effect on the economy. It will limit lending at both the consumer and the business level, and slow our economic growth potential. Again, it's hard to predict because none of these rules have ever been finalized, and so we don't know if they're really going to jump in themselves. But I'm starting to see a pattern. So we see it in the student loan market. They jump in. They say we can do student loans, and private institutions, private banks leave it. Healthcare. We've got the Patient Protection and Affordable Care Act that come in and said, okay, you can sell health insurance if you sell it our way. What happens? Well, insurers leave the market. If that pattern holds, the same thing's going to happen with consumer lending. In that health insurance market, and we could see a similar thing going on with financial services, is essentially the health exchanges are going to become a redistribution. That's all they are, really, is that the young people that are being forced to buy insurance that didn't have the incentive to before are subsidizing the older members of the policy. That's the whole plan. It's simply just a redistribution from one segment of the economy to the other. Whenever you have redistribution through income taxation, through any kind of activity, if you take from one sector of the economy and you send it to another, like bailing out auto companies, you slow down economic activity. Because you've changed people's incentives. It doesn't matter what market you're in. When you take from one to give to another, you change incentives, and you reduce the incentives to invest, to save, and we know economic theory and empirical and historical evidence show us that when there's higher rates of savings and higher rates of investment, you get higher rates of economic growth. Redistribution reduces the incentives for savings and investing. So it doesn't matter whether you're in the health market, whether you're in the overall income economy, any redistributions slows things down. So that's what I expect to see the effect of the health exchanges, since they are just a redistribution of income. They will be one factor in a slower growth economy.